Most investors don't fail because of the market, they fail because of themselves. And the worst part is that it doesn't look like failure. It looks like you're staying informed about what's happening in the markets, you're regularly checking your portfolio, you're trying out new things, doing just enough to feel like you are in the game. But there's a word for this: drifting. And in 10 years of building a multi-million-dollar portfolio from scratch for myself and coaching thousands of high net worth investors, I have never seen anything destroy wealth more quietly or more consistently than this. In this video, I'm going to show you the 3 biggest shifts that I had to make to build a portfolio that's worth several times more than what most investors ever accumulate. I started investing by putting 30% of my paycheck into stocks without a mentor or any background in finance, just saving money from my job and putting it to work. And in my very first year in the market, I grew $15,000 to over $100,000, which is 800% return. And in that moment, I genuinely thought that I was a genius and I had it all figured out, how the markets work, and it's actually not even that hard. But then when the market turned, I lost most of it. And that's when it became very stressful, and that's when I realized that I actually had no idea what I was doing. And I had to figure out how the markets work in down environments, when is the right time to buy, what should you be buying in different market conditions, how to protect what you have built when everything is falling. So I went back to the basics. I kept saving, I kept investing, studying everything that I had gotten wrong. And after a couple of years, I have rebuilt my portfolio up to $400,000. But then the market corrected again and it dropped down to $200,000. So I went back, I kept studying, kept improving myself, then I went up to $600,000. Then it dropped again to over about $300K. Then I went to $1 million, dropped to $600K. Then I went to $2 million, dropped down to $1 million. And that is what my compounding journey actually looked like. Along the way, there were days, single days, where I have lost over $200,000 in a single trade. And that is the part that most people are not talking about, because no matter how good you are as an investor, on the road to building real wealth, you are going to go through moments like this, where you have large drawdowns, painful losses, periods where you might be more prepared than ever before and still nothing is working. Your reaction to those moments is what is going to define everything that comes after. Because after going through 2 or 3 experiences like this, not 1 out of 10,000 investors will keep going with the same hunger and the same ambition. Most people will reach a few $100K and get really comfortable and just stop their wealth building journey right there. But for me, every single time I took a hit or a drawdown on my portfolio, as difficult as that moment was, my mind went straight to one place. What did I get wrong? What do I need to learn? And that question is what made all the difference. Now, the pattern I just described, building, losing, rebuilding, never quitting, is the opposite of what drifting is. So what does drifting actually look like in practice? Let me give you an example. There are 2 surgeons, the same medical school, the same residency, the same salary, $400K a year. Both of them are excellent at their jobs, but one of them treats investing like they treated medicine. So they're studying it seriously, they build a real strategy. The other regularly contributes to a retirement fund, has a couple of index funds, checks the portfolio occasionally, and means to learn more. Even has a tab open right now with an article that they haven't finished reading. Now, neither of them thinks that they are doing anything wrong, but in 15 years, one of them has built a portfolio that could fund 3 lifetimes, and the other one is still working 60-hour weeks because they have to, not because they want to. They had the same income, they had the same starting point, the same intelligence, but completely different outcome. And that gap was not talent, it wasn't even money. It was just one decision that one of them made quietly without an announcement. And I see this play out the same way every single time, where someone builds $300,000 or $500,000, maybe even $1 million, and they have done more than most people around them. But then they stop. Not because they have already reached their financial freedom goal, but because they have hit comfortable. Whenever it happens and the hunger drops, without even realizing it, they start drifting from building towards something that they eventually wanted to achieve to simply protecting what they have. And if your real goal is $10 million, being comfortable at $500,000 means that you are 95% away from where you actually want to be. And every year you spend at comfortable at that level is a year of compounding that you will never get back. So why does drifting happen in the first place? Because most investors are following advice that were never designed to make them wealthy. Stay diversified, dollar cost average, don't time the market, hold forever. And that advice isn't necessarily wrong, but it's designed to keep you comfortable, not to get you to financial freedom. Let's take 2008 as an example, where the market has dropped 56%. If you just held through that crash, it would have taken 4 years to get back to where you started. 4 years just to break even. And that is what conventional investing actually feels like from the inside. Now, look at what the best investors in the world are actually doing right now. Warren Buffett, Druckenmiller, the top institutional managers. None of them follow the buy and hold forever playbook. When markets are extended and are running hot, they're quietly building up their cash positions and they are scaling out of their winners. And they're waiting patiently so that when the market corrects, they can go and deploy when their system gives them the green light. For Buffett, their system is built on fundamental valuation, specifically how the total value of the stock market compares to the size of the actual economy. And when that ratio gets too high, he raises cash. When it crashes back down to attractive levels, he buys aggressively. Not because he feels good, but because the data says it's time. Doing the right thing in the markets almost always feel like you're doing the wrong thing in that moment, which is exactly why most investors never do it. Their emotions pull them in the wrong direction at every critical turning point. So here's what I learned. Drifting is not fixed by motivation or by trying harder. It is fixed by making 3 specific changes. And every investor that I have worked with who has built real wealth has made these 3 changes. The first shift is the most important one. And it comes down to one question that should be driving every single investment decision that you're making. Is now a good time to take risk in the market or not? That's it. That's one question answered with data instead of feelings changes everything. Most investors are never asking this. Instead, they make decisions based on what they read in the morning, what the news are saying, what their gut tells them, what everybody else around them seems to be doing. But when markets are going up and they feel confident and buy more, when the markets drop, they start panicking. And then they're selling because their emotions are in the driver's seat at every single critical moment, and their emotions, without them even realizing it, are almost always pointing them to the wrong direction. This is what I call systematic value investing. It is the methodology that we have built at Rose Tree, and the core of it is simple. Instead of reacting to what the market is doing, you follow a simple process. You monitor real-time data from the market, and the data tells you whether the conditions support taking risk right now or whether you should be protecting your capital and patiently waiting. When the data says risk is justified, you deploy. When the data says risk is elevated, you raise cash and step back. It is not about predicting the market. Nobody can do that consistently. It's about having a clear, structured process that removes your emotions from the equations and replaces them with a clear criteria. And this is the part that most people miss, because your emotions are not just unhelpful in markets, they're actually a contra-indicator. So let me give you a real example from our own system. Earlier this year, the data flagged that risk was elevated on one of the best performing stocks in the market. So we moved to cash. 3 weeks later, that stock has dropped 40%. And everyone who followed their emotions and held that stock just lost serious money. But our system then flashed the buy signal. So we deployed capital at the bottom, and within 120 days, that same position was up 80%. The same stock, the same time frame, completely different outcome. The only difference was the process. The second shift follows directly from the first one, and here's the part where most investors only understand when it's too late. If your portfolio drops 50%, which has happened multiple times in the market, you do not need a 50% gain to recover. You need a 100% gain just to get back to where you started. This is years of compounding gone, and the bigger your portfolio gets, the more devastating this becomes. And that's exactly how I manage a portfolio. When the conditions are favorable and the trend is in our favor, we are fully deployed. But when we get risk signals, stop signals are starting to appear, we begin to scale out, take profits on the positions, and building an elevated cash position. When the trend breaks, we move to up to 50% cash or even more. And when the system gives us the green light to buy again, we start deploying capital aggressively into discounted assets. The goal is never to call the exact top or the exact bottom. The main goal is not to be fully exposed when the market starts crashing, and to have capital ready when everyone else is panicking and you see quality assets on a fire sale. That is how you stop round-tripping your returns, and is how you actually start compounding toward a portfolio that you're trying to build. Now, let's talk about the third shift that I had to make, and to be honest with you, this was the hardest one for me to make. You see, most people set outcome goals. For example, I want to make $10,000 a month from my portfolio, and I want to hit $1 million by next year. And here's the problem with that. What happens when you hit 3 bad months in a row? What happens when a drawdown wipes out most of your gains? How many people will keep going with the same hunger and the same discipline? Because I can tell you, not many. And I know this because I have lived it. In 2021, I was making $30K a month from trading of my portfolio, and that number became my entire focus. So I started optimizing everything around hitting that number consistently. What I didn't see coming was that I was risking 200K to make 30K, which is completely backwards risk to reward ratio. And when the market turned and one of my trade lost, I ended up losing $200,000 in a single day. Not because I was unlucky, it's because I was optimizing for the wrong thing entirely. You see, my real goal was never to make 30K a month. My real goal was to build a $10 million portfolio. But everything I was doing at that point was designed around the monthly income target, not around becoming the kind of investor who could actually build and manage wealth at that level. And that's the big difference between outcome-oriented and identity-oriented. The outcome-oriented investor asks, how do I make more money this month? The identity-oriented investor is going to ask, what does a person who builds $10 million in a portfolio actually know? What are the skills they have? How do they think about risk? How do they make decisions when the markets are crashing? And how do they optimize everything towards becoming that person? Because here's the truth, if you optimize everything you do toward becoming a world-class systematic investor, the money is going to follow. It just has to. The skill compounds just like your portfolio does. But if you optimize for a monthly number, you will always be cutting corners. You always take on too much risk in the wrong time. You will always be just one bad month away from abandoning everything. And the stronger your foundation is that you're building, the further along you can go. There is no shortcut to building that foundation. Here's the honest question I want you to sit with after this video. If you keep investing exactly the way you're investing right now, where does your portfolio actually end up in 10 years from now? Not best case, just the realistic scenario. Are you going to be a $10 million or a $20 million portfolio manager completely financially free? Because here's what we see every single time we do a financial analysis with a new client. There's a deeply uncomfortable gap between where they think mathematically they will be ending up if they keep doing what they're doing versus their reality. And that gap cannot be closed with the same approach you already have. It's not closed by working harder, because you can work all day on the wrong thing and still get nowhere. And it's also not closed by researching a few more stocks. It is closed by making the 3 shifts I just walked you through, and by building the skill set of an investor that you actually need to become in order to manage portfolios at that level. The good news is that every single person watching this video is capable of making these shifts, but not everybody will. And that's just the reality. The question is not whether you can, the question is whether you will decide to, because the decision you make today, compounding over the next 10 years, is worth several times more than any single investment that you will ever make. And if this resonated with you and you are serious about making these shifts to your own portfolio, this is exactly what we do here at Growth Street. We work with investors who have real capital, typically between $100K to $10 million, and we help them to build the system, the skill set, and the mindset required to get to the next level. We will help with the research, and we will signal when to take risks and when to wait patiently. We will walk alongside you so you're never making these decisions alone. Today, our community manages over $500 million in investment portfolios following this exact approach. And if you want to find out whether Growth Street is a right fit for you, the link is in the description below. Book a free call with our team, and we will look at where your portfolio is at today, run the numbers on where it is realistically heading to, and show you exactly what it would take to close that gap. There's no pressure, just clarity on where you stand and what is realistic and what is possible. And if you know someone who has been investing for years and they still feel like they're going in circles, please just send them this video. Thanks for watching.